Talking with a mask is so much work, eh? Gosh. So let's start with, where's our 2.3? Sure. Okay, no, it's fine. We'll do 2.3 via board. Okay. Let's do 2.4. Okay, now in the interest of no, forget it. It's cool. We'll make it work. Okay, right. For 2.4, here we were basically just identifying. Let me zoom in. Okay. So here the job was simple. We were supposed to, they wanted us to calculate our current assets, non-current assets, current liabilities, non-current liabilities, and what have I missed so far? What's the other one? Owner's equity, I think. That's it? Current assets, liabilities. Okay. Yeah, that's really it. Okay, so cool. Did you guys manage to get a total of 700 for your non-current assets? Yeah, just adding them together. So for equipment, what was it?
I did 2.6, but I never scored on any. I did the wrong one.
You did no. You were supposed to do 2. Oh, we did 2.6 together. All right.
I know what's going on.
All right. So in 2.4, what was the value of equipment?
It is on page 10. That's 2.4.
2.4 is on page 28 in this. It's on page 28. Yeah, it's 30. It should be 2 pages ahead for those with the newer textbook. It's 120. Okay. And what is vehicles? 2,000. 180. And what is land and buildings? 400,000. My friend, what are you smoking over there? All right. So then that's 700,000 the total there. Okay. So we're all in agreement. So can you see? These are easy marks. Whenever you see question 1, you should be looking at it and saying, those are my marks. But if you don't know what an asset is, a non-current asset is, then guess what? You're not going to get those marks right there. Okay? Right. And then let's move on. Current assets. How much was our debtors control? Or our debtors? Same thing. 24,000. Okay, petty cash. All right, cash float. 1,000. And then finally our trading inventory. 15,000. Okay, right, done. Okay, and then we obviously should have a total of 44,000. Okay, then can I just see by show of hands who actually did it? I'm not gonna put you on the spot or anything. I just want to know who actually did this 2.4.
I thought I didn't say original products.
All right.
But I did learn off.
You did 2.6 and?
No, I didn't learn off.
Oh, you didn't know?
It was just 2.6.
Okay. Maybe I didn't mention it.
Yeah.
Okay.
I don't think you did, so I think that's everyone only did 2.6.
Or maybe you guys are just trying to play me. All right. All right, all right, all right. Well, it's pretty simple, so we can do it as we're doing it now. It's not translate. I just wanted to know. Okay, so in terms of non-current liabilities, okay, so we obviously already have these things on the board, and I think you shouldn't have too much trouble mastering where should go. Okay, so obviously mortgage loan. How much was that? 250. All right. Should I trust him?
Yeah.
Is it 250?
Yeah. So we'll
Okay.
minus 100,000 from 350,000. It would be 250,000.
Okay. And somebody tell me, how are we getting the 100,000 for the bank loan? For Puman's Bank. Loan from Puman's Bank. Yes? Okay. All right. Guys, this was the real trick in this question. Okay. So typically, you just look at that Puman's Bank and you just say 124,000. Okay. But as she highlighted, we actually need to remove that 24,000. Why? Because they said it's redeemable. All right. Therefore, this is something that's due within this financial period. Okay. So we need to remove that. It's not a non-current. It's actually a current. In other words. So then there you are supposed to go 100 and oh my bad. 124 minus 24, which is redeemable. Okay, and that's how we then arrived at the 100. Okay. All right, and then obviously we add those two together and then we get our total liabilities. Okay, right. Then obviously moving on to our current liabilities, we had the bank overdraft, which was 2,000. We had um, the short-term portion of the long-term loan, which was the 24,000, which we just played around with now. And then when you add those together, you obviously then get with the creditors control, you obviously then get the 56,000. Okay. So we had done everything that needed to be done there, and then obviously the last thing that they asked for us to do is to calculate the equity in the business. Okay. How did we calculate the equity in the business? By yes, 100% is on the board. All right. And as you can see, the first formula that we had was the accounting equation. The assets is equal to owner's equity. So if you had totally forgotten about the accounting equation, you would have been like, but then how are we supposed to calculate owner's equity? Okay. And this is where we were saying, understand, master, and then here we are applying. Okay. All right. Anyway, and so our owner's equity worked out to be the 338,000. Now, you're probably looking at the capital minus drawings plus profit is equals to owner's equity. That's just something I thought I'd probably make you aware of now, that you can also calculate owner's equity that way. Okay? Right. All right. But obviously we didn't have capital in this exercise, and we didn't have drawings, and they also hadn't given us profit. So in this exercise, we obviously couldn't use that.
So if you replace the assets with capital in this case, if you didn't have the assets plus any capital.
No, because some of your capital might not necessarily be applied to assets. Does it make sense? So you could very well end up messing up your calculation there. Okay. And plus, you still don't have drawings. You still don't have profits. Right. Awesome stuff. Any questions? No question. Cool. Right. Then we had 2.3. And you guys said you hadn't. Oh, you didn't hear me say it. Yes. Can I? don't know. Sometimes these things respond to this, sometimes they don't. I think they're being control sensitive. Yeah. Or maybe it'll shut down over time. You're feeling cold? Do you?
Yes, I do.
Okay.
Must I make it hot or just switch it off?
Just switch it off. Just switch it off.
I can make it room.
I'm going to bake. No, switch it off. Just switch it off.
I don't know how to switch it off. No, like if you push the button, it just makes it like that.
That's what happened to me.
So I'm gonna put on 21. I'll make it room temperature.
Guys, the moment I start baking, it's going up. Or going down, actually.
I think it's good. It doesn't get worse.
Just sit down. These ungrateful people.
No, they're hungry. Yeah. No, but I was on 18. That's why I was so
And now it's 21.
Now it's 21. Thank you. That's why
End of conversation. We're not going that far. All right. So, guys, let's move forward. I want us to quickly just do 23. Okay. All right. So let me just read out this question since we didn't actually get a chance to do it as homework. 2.3. Okay. All right. So as always, first thing that we do is we read the required. Okay. The reason why we read the required is because we want to know what's going on, and we want to focus our attention to what is actually needed, as opposed to, see, what would typically happen if we read the general question, we then go to the required, all right? Then we end up going back to the question or the information in the question to then extract what we need. But if we then read the required first, we automatically know, okay, we're calculating profit. So all my income, all my expenses are things I need to circle or pay attention to in order to answer the question, okay? So in accounting, we're always taking time, so that would obviously then save you time in the test or exam. Okay. That said, under the required, you are Peter's bookkeeper and have been asked to classify the business's liabilities into current liabilities and non-current liabilities on 31 December 2007. Assume that all premiums due to Best Finance CC for the year have been paid by 31 December 2007, okay, including the premiums due on 31 December. Okay, so before we go any further, what I would do is I'd draw a timeline quickly. Okay, let me stop playing around with this funny color. Let's do green. Okay. So here they want us to calculate the non-current. Let me just do this quickly. We want the non-current liabilities and we want the current liabilities. Okay. On 31 December 07. Okay. Just doing a quick timeline here. Okay. Okay. Right. Now we can get into the information there. It says on 1 January 2007, Peter bought a vehicle on hire purchase for 260,000. This is not the cash price, but the hire purchase price. This means that interest for the whole financing period has been added to the cash price to arrive at 260,000. Okay. His vehicle is fully financed through Best Finance CC. The terms are 20,000 deposit, okay, and repayments of 2,000 per month for a period of 10 years. And there you can see the calculation: 2,000 times 12 whole year times 10 years. You have 240,000. Starting with the first premium on 31 January 2007. Assume that Peter is a sole trader and that his business's financial year runs from 1 January to 31 December. Okay, right. So in other words, let's do this. No, let's do this. Okay. All right, so let me just redo this because the certain section in my screen does not want to behave. Okay, so let's do this here. Okay. Okay, 1 January 07, and this is 31 December 07. Okay, and we want to find out non-current liability and current liability. And here we were told that they're paying first premium is going to be on 31 January 07. Okay, and every month they continue to pay a 2,000 premium. Okay, all right. Let me use a different color here. This is 2K. 2K. I'm just going to keep doing that. Okay, just so that we get the point. Okay, right. Cool. Everybody together so far? All right, perfect. Then, how much do we owe on 1 January? Somebody tell me.
2,000.
How much?
Well, you paid the 20,000. Or how much have we spent, or how much we have spent? And
How much?
You pay.
How much do we owe on 1 January? 240, right? For this exact logic that you are highlighting. Initially, we obviously owed 260, and then we had a deposit of 20,000, okay, which then gives us 240, okay. Okay, so we've managed to do that much, okay. Then we know that we are paying 2,000 every single month until the end of the financial year. So how much do we actually pay off?
24,000.
24,000 in a year, okay, and that's 12 times the 2,000. So I'm just going to write the 24. Okay, and now we're deducting this because remember we want to find out how much non-current liability and
That number from the 240,000.
to arrive at how much do we owe at this point, at the end of the year. Does that make sense? Everybody together? Okay? Right. Where are you? Then we'll get you to where we are.
Minusing the 24,000
Uh-huh. From 240.
with the non-current liability.
Not the non-current, to get the total liabilities on 31 December. Does it make sense? Because remember, at the beginning, we owed 240 at this point on the 1st of January. Does that make sense? Then we know we're paying 2,000, 2,000, 2,000 every single month. So by the time we get to this point, we're not owing 240. Does that make sense? Okay? So then we want to calculate how much are we owing when we're here. What's the balance on the vehicle that we owe in a nutshell? Okay? So exactly. So that then gives us 226. No, it can't be.
Wait. No, I made a mistake.
216. Okay? So what we owe at this point is, okay, but remember the question asked us, we want to know what our non-current liabilities are and our current liabilities are at that point. Okay, that's just the total of what we owe, right? Okay, so then how do we work out? Whoa. How do we work out how much we actually save this thing before it dies? How do we then work out how much we actually have in non-current liabilities and in current liabilities? Somebody tell me. We now know how much we owe on 31 December 2007. How do we work out what is non-current and what is current? Yes?
Correct me if I'm wrong, but is a current asset something you have?
We're talking liabilities here. We're not talking about. Yes.
Something, a liability that's something that's longer, that's current, that's under 12 months, right? So
12
would that
months
be
or less.
the 2,000? What is the 2,000 per month? Would that be the the current
That would
liability?
be current, yes. Because that would be, we'd be owing that.
And at the end of the year, that number is the non-current. Would that be the, what you owe after all of the 2,000?
What we owe after
The 2,000.
the year
Yeah.
is non-current. Does that help you?
Yes, it does.
Okay. So then how do we move forward?
But we can take the projection and use it. It says for 10 years.
Right, 100%. So we then now need to look at the year ahead, and we need to say to ourselves, okay, we know that every month we're going to be paying 2,000, 2,000, 2,000. Okay, we know this is 12. There's 12 months here. Okay, right? So then we say, okay, this is the 2,000, 2,000, 2,000. We did this calculation before. So, okay, there we go. So here we're going to say minus 24,000. Okay, which gives us what? 192,000. Okay, so now we can answer this question. Of that 216, how much is current? We just calculated it. 24,000, because that 24,000 is due within 12 months. Make sense? So 24,000. And then how much of that is non-current? 192. Okay, and you add those two together, you're going to get this total of 216. Okay, so very important in accounting, we need to understand what are they actually asking us. Okay, and the only way we really get comfortable with that is getting used to the terminology. And the only way we get used to the terminology is by doing question after question after question. Okay? All right. So this exercise seems very simple, but even for me, when I first tackled it in preparation for class, it was like, whoa, what exactly is going on here? What are they actually asking? Okay? All right. So timelines can help you quite a bit in terms of breaking down where am I, what do they want? Where am I, what do they want? Okay? Cool. Any questions before we move on? Yes? No problem. I've been doing a lot of summarizing today. Not a problem at all. Okay. You guys can still see, right? All right, I'll start here. So, first things first. Let me actually start. First things first. What did they ask us to do? They asked us to break down the non-current liabilities and the current liabilities as at 31 December 2007. Okay, so we did our timeline, then we said to ourselves, okay, cool. How much did we owe at the beginning of this financial period? Okay, we said, okay, we know the value of this thing was 260. Okay, yes, but however, we paid a deposit. So we need to deduct 20,000 from that deposit, and that's how we arrived at the 240. So then we realized, okay, on 1 January 2007, we owed 240,000. That's what we owed. Okay, but we know that. Remember, we still want to find out our non-current and current at this point. Okay, so we know that we're going to be paying 2,000 every single month. So as such, this 240 is not what we're going to be owing at the end of the financial year. Make sense? So then we need to work out what we actually owe in total on 31 December 2007. So then we said, okay, we know we're paying 2,000 every single month. Okay? We know a year is 12 months. Okay? So then we said, okay, 12 times 2,000 or 2K. Okay? And that's how we got the 24,000. We then deducted that from what we were owing at the beginning to get to what we were owing at the end. And that's how we then got to the 216,000. But then we said we have a problem. We have a problem because the 216 is encompassing both our long-term and our short-term liabilities. We want to know how much of that is long-term and how much of that is short-term. So then we said, okay, we know that by definition, short-term liabilities are those that we have to pay within 12 months. Okay? So we then said, okay, how much do we have to pay within 12 months for the following year? Then we said, okay, 12 months. We know every month in the following year we're paying the 2,000 for 12 months. So we did the same calculation.
24,000, yeah.
Yes. 24,000 again. All right. And then we said, okay, so that means that whatever is owing after the total of what we pay within the 12 months is then non-current, because it means we're going to settle this more than a year, in more than a year, or after 12 months. Make sense? So then we know that this is obviously then our non-current liability, okay? And then this is obviously then our current liability, which is what we then have over there. Okay. Does that make sense?
And then we have to do it for 8 years.
No. Fortunately, that wasn't the question.
Over here it says for a period of 10 years.
Yes, but in the question they said,
Oh, I was just reading the thing.
you have been
No, I'm
including.
just saying in general, like not part of the question, but because it's 10 years, we
Okay.
keep repeating this process, right?
All right. Yes, in general. Don't in general in your test or exam, eh?
No, I'll stick to the question.
All right. Thank you very much. Okay. Right. Cool. So at this juncture, I'd like us to. No, actually, we can. Okay, we'll read the next question and I'll give you guys a break. Okay. Okay. Right. So the next thing that I want us to do, I want us to start playing around with the accounting equation, and I'd like us to do that by way of going into question 2.5. Going into question 2.5. Okay, so we're just going to read what's going on there, and then I'm going to give you guys a break. Do I have 2.5 here? Yes, I do. Nope. That's not the one I'm looking for. All right, cool. Question 2.5. So, under the required, it says, calculate Roger's equity in his business on 31 August 2007. Okay. Show the effect of each transaction on the accounting equation and explain your findings. Right. Okay, let me give you guys a break, and then we'll get into this in the next session. Who has my register? All right, so please be back by 2. Has everybody signed?
No.
You have. Oh, yeah. Yebo? Uh-huh. Yeah. Which one? The one we just did? Okay, okay.
I want to understand how we got to 195.
Okay. I just want to ask some. Is yours quick?
I would actually like to listen.
Same thing?
Yeah.
Okay.
No, not specifically, but I would like to listen.
Oh, okay. No problem.
I get
I'll put it down.
to 216.
Mm-hmm. You get how we got there, yeah?
Yes.
Mhm.
So why did we have to carry on? Why am I not reading the question?
So I wanna go back to the timeline, because that just it helps us see where we are and why exactly we're actually doing that. So where did we do this again? We did 2.4. Yeah, but we just did it freehand. So there we go. So we're here, right? You're talking about the 216. So we're now over here, basically, with this. Okay. Now you're asking, why did we go on to further break it down? Okay. So remember, since we're here, in order to find out what our non-current and what our current is, remember, current is what are we owing with within the next 12 months. Does it make sense? What are we owing within the next 12 months? So everything that has happened here is behind us. You see, so basically behind us, we're still moving forward. Does that make sense? So as a result, we're then saying, okay, of this total that we're owing on this car, how much of it are we paying within 12 months? And how much are we paying within more than 12 months? Or have to pay after 12 months?
The first year,
Mm.
we actually don't take it into consideration.
Everything that has happened here?
Yeah.
Yeah, it's done.
Exactly. So we've always got the second of.
Not always, it depends on the question. Because remember, here they're asking us how much is non-current, how much is current, how much is long-term, how much is short-term. At this point, does that make sense? At this point here. Okay. So they're no longer concerned with this. The only reason we were working with this here was so that we could arrive at how much do we actually owe at that point. Does it make sense? Okay. Are we good?
Yeah, we
Hmm.
I wanted to ask, how are the tests or exams going to go? Is it going to be more practical,
Mhm.
theory, and in theory, are we going to have to apply?
Definitely.
Okay.
Definitely. Even
I
in
mean, like,
but to answer your question in terms of
Mm.
like is it more theory or practical? It's definitely more practical, but for test one it would be more, actually not even in test one, but there is a lot more theory in test one because isn't we just have you just started, but otherwise majority of the stuff is going to be calculations of some sort.
so what I mean by applying, I mean,
Uh-huh.
like, either you're going to ask this, like, let's just say, what's the difference between financial accounting and financial accounting?
Love that question. They do. So even if you don't get it in test one, you probably could get in test two or in the exam. Yeah.
So how many tests do we have?
So I was speaking to the BCom guys, and I think you're quite similar
Okay.
in that what they've done with them this year is that they're actually giving them an assessment. So what would then happen is the assessment is out of 100 marks, and so it's like a take-home assignment. So you then can tackle it in your own time, and then you have to submit. So I think they have actually uploaded it on BC learn already. At least for the BCom guys, they're already seeing it.
So
So
first year.
yeah, first year.
Are we doing the same thing?
Same textbook.
Is it?
Same textbook. So yeah, so it could be one assessment, then test 2, and then the exam. Or it could be 2 tests and then the exam.
And then for test 1, it's from chapter 1 until chapter
3.
3.
Yes.
So it's close.
Yeah, we're close to getting there.
Thank you.
All right. By the end of this month, I don't know. By the first week of April,
And so
we'll be done.
this week on our timetable,
Mhm.
it's like early April.
Yeah, early April. The first full week of April, basically, before you guys go for. Oh no, after Good Friday.
Yeah.
Yeah. So then that's the second week of April, actually.
Thanks.
Cool. Yeah, boo.
I've got some in terms of that, why should I?
Tutorials. That's a different module altogether, you know? Tutorials, I'm trying to understand. How do I come in there now?
Because when I applied, they said I should take accounting.
Aha, okay. Yes, so the tutorials are supposed to happen with a different person altogether. What they then do, and they're working on a different syllabus, but obviously it will be speaking to this, and it's just to give you those fundamental stuff. So I did tutorials last year, I think, or the year before that. And what you then will be doing is calculating things like proportion, but with markup and profit. And I think also you'll be learning the basic accounting equation. You spend more time. So it's just extra time on certain key principles or concepts. Yeah.
So you know what's supposed to happen?
I don't know. They're supposed to talk to you guys about by now they should have given you, because I know a lecturer in Pretoria is already started giving his tutorials. So no, it's not. It's not that difficult. What makes it challenging is the fact that it requires constant practice. So as long as you're practicing, and like I said before, obviously you knew, so you wouldn't have heard this, but as long as everything that we learned in this week, you understand that before us going into next week. Because when we go to next week, I'm going to give you more, and based on that foundation. So exactly. So if you don't understand what we did this week or the weeks before, when we now get into next week, it's going to be like, oh my God, what just happened? Does it make sense? And then the other thing is, even some people who do understand don't practice. So they get to a week before test time, and now they have all the stuff that they have to master, and then it just overwhelms them, and they just give up before they even get to the exam or test. So I'm a bit confused because I don't know if they're going to be giving you guys 2 tests, or they're going to give you an assessment and then a second test and then the exam. You see? So that's where I'm a bit confused, because the assessment apparently is 5th of May. You see? So, but test week is, as she was highlighting, let me actually look at the timetable. In June, yes. That's right. Yes, you may. So you see here, test week, saying you guys are going to write test 1 on the 16th of April. So that's why I'm like, I'm not so sure what exactly is going to be happening. 1 to 3. All right, no problem. All right. Cool. Okay, cool. All right, so we have finished with that. Now I want us to begin to delve into 2.5. Forgotten which one we clicked on. Yeah, it should be this one. Okay. Should enable this. Okay, cool. All right. So we found out the required. What they wanted us to calculate was the equity for Roger. Wanted us to calculate the equity for Roger. Okay, so everybody sign now. Huh? Hey, you bring it back when you before the end of the lecture or whatever. You don't have to bring it back now. Right. So, did I mention that you guys need to download this?
No.
The student work pack?
No.
Okay. So, it should be there in more resources under lecture slides. Just double check that it's there now, somebody please. You can do it on your phone or PC. Okay, as I begin to go along here, it says Roger Pierce, all right, commenced business as a sole trader on 1 August 2007. At this point, he only had 40,000 in the bank. Okay, he had 40,000 in the bank on 1 August 2007. Remember, we're doing this for 31 August 2007. Okay. Being 10,000 from his personal funds and 30,000 from the bank in the form of a bank loan. Okay. Roger entered into the following transaction during August 2007. Okay, so do we need to record what he had in the bank on 1 August? Do we? Yes, we do, because that's what we started with at the beginning of the month. Does it make sense? Right, when we get into T accounts, one of the things that I'll be complaining about, reiterating quite a bit, is whenever you open a T account, you need to make sure you need to check whether you have an opening balance or not, okay? Before you do anything, that's the first thing you need to do. And there's always 1 or 2 marks right there. So when people miss out on the opening balance, it's like you just threw away 1 or 2 marks, okay? Right, so make sure that that's the first thing you do. So here we do actually need to jot that down. So how is it going to affect our accounting equation? What is bank? So that's an asset. So what are we going to do with our assets? Oh, sorry, let me zoom in here. Okay.
So you were talking about, you have to put things on the credit and debit.
Uh-huh.
With the liability, let's say you take out a bank, would you put that necessarily in one part of it, credit, because you're gaining money from?
Okay, so
Liability, because even as a liability,
yeah,
you're still getting money. That makes sense. You're gaining an asset, but you're also custody of liability.
So can you keep that question for next week when we do the T accounts? It should be. Okay, just remind me that I think I will remember your question. So just remind me when we start doing T accounts, just remind me about that, and then I'll take it from there. Okay, because there's a whole cross-referencing, which I think you're starting to talk to, whether you realize it or not, double entry system. Okay, and I don't want to half answer your question. Okay. So let's start with 1 and then we'll progress. So we know that obviously bank is affected because we have 40,000 cash sitting in the bank, right? What is bank? Somebody said it. It's an asset. What type of asset? Yes, it's a current asset. Okay. So under assets, we're going to put 40,000. Okay. Are we going to put a plus or a minus? Okay. Why are we putting a plus? Okay. So the reason why we're putting a plus is we're asking ourselves, this 40,000 that's sitting in the bank, how does it affect assets? Whenever we're putting a plus or a minus, we're asking, how does that transaction affect the category? Okay? Does it increase or decrease our assets? It increases, okay? So since it increases our assets, then we're going to put a positive 40,000. Does that make sense? And we now go to what other accounts are affected? Liabilities, yes. Why liabilities?
Well, if you have a liability, you open with that 40,000. Well, I'm just guessing so you can tell me wrong. But if you start with the 40,000, let's say, and then you get 2,000 on the next column where the assets would be 38,000.
What does the question say? What did they tell us in the question? All right, we can't make assumptions when we're doing a test or an exam.
I check for 11,000. So then would it be 40,000, and you would have like 11,000 in there, and then the bank.
We're getting 11,000.
I don't know if I'm looking at the right thing. It says purchase merchandise.
We're still dealing with that top. We haven't yet stepped into the transaction. You wanted to say something? Well, question 2.5.
No, I'm saying what?
That I'm asking. Yeah. So we've established another account that's affected is liabilities. Okay? Because we've taken out a loan. A loan is a liability.
It should be 30,000 in liabilities. What? I think. Because it says it's a bank loan.
You guys come
It's a question. It's a question.
Your question is, you're asking me a question. I was asking you guys. Her question. Yeah. Have we answered your question?
No, but
Okay, so your question was, what was I asking?
yeah.
Okay. So what I was asking is, we know that loan is a liability, right? So what are we going to do in the liability question? Sorry, the liability column.
Plus liability.
Minus 30,000.
Well, you're adding to an expense. Your expense is going up. I don't think.
So remember what I said? That
Well, there's a plus at the
we're asking ourselves, how does this transaction affect the liabilities? So somebody did mention it. I can't remember, can't recall who. But as a result of taking out this loan, is that increasing our liabilities or decreasing it? So what should we do? We should plus, okay? So then it's a plus 30,000. Okay, does it make sense? I know we're thinking a liability is something that's going to take money away from us. We want to make it a negative. Nope. We need to think, how does that transaction affect that category or column? Okay. Right. There we go. All right. Then what else was affected? Yes. Why? You want it? You want it? Money that was contributed to the business. And I think you wanted to say something about capital. Oh, yes, this mask. Sorry. It's you. All right. What exactly do you want to say? The capital contribution is 10,000. Okay. Now, how does capital contributions affect owner's equity? It adds, it increases owner's equity. So here we're going to put a plus 10,000. Okay. Another way that you can quickly check, am I on the right path or am I completely just throwing rubbish onto this paper? You can look at the accounting equation. Your assets is a plus 40,000. So whatever is on the other side of the equal sign needs to equal that. And if we add a plus 10,000 to a plus 40,000, do we get a plus, to a plus 30,000, do we get a plus 40,000? Exactly. All right, cool. So then let's, yes. Why I put the on liabilities. So we went and we took a loan, or Roger went and took a loan for 30,000, all right, for that amount that's sitting in the bank. So now the question that we ask ourselves, a plus or a negative is based on how that transaction affects the column. So if I buy assets, right? Let's say I buy equipment. Is that going to increase my assets or decrease my assets? It's going to increase. So I then need to put a plus and then the value of that equipment. If I go and get a loan for 100,000, that's a liability. You agree with me, right? So I now need to enter that 100,000 in here. Now the next question is, should that be a plus or a minus? It needs to be a plus because it's increasing my liabilities. It's increasing how much I owe. Does it make sense? Okay. If I say, oh, I sell something and I get 50,000 Rand, and I say, you know what, let me pay off some of the debt that I owe. Okay. Let me pay some of this bank loan off. How is that going to affect my liabilities? It's going to lower them, right? So I'm going to have a minus 50,000. Now let's say, obviously, this 50,000 came out of my bank account. What is bank? It's an asset. So what do I need to do in assets? The minus 50,000. So can you see? It's all about how does that affect the category. So here we'd have a negative 50,000. Does it make sense? Because we have less money now. We have less assets. Cool. Good question. All right. Guys, there's no point in me progressing if you don't understand. I'd rather take my time. I'd rather we be behind and figure out how to catch up to where we need to be, provided you guys understand. Okay? Yes. If you had to pay, yeah. It will only affect the liability and the assets. It will only affect the liability and the assets. Yeah, because I'm paying cash. Even if you're, it wouldn't affect owner's equity in any way. Yeah. Remember, owner's equity, we're talking about increases and decreases in the value of the business or the value of the owner's share in the business. Okay. And so don't worry, the more questions we do, the more it'll begin to make sense. Okay. But I understand why you're obviously making that assumption. All right. Now we can step into the transactions. Okay. So first transaction, 2nd of February, cashed a check, and I don't know if this is in your books. In my book, it says from 2000. It should be for 2000. Okay. I know the 2020 and 2019, that's how it is in those textbooks. I don't know about the 2021. Being for petty cash. Being for petty cash. So, first question. Right now, we're only focusing on the accounting equation. So we're not gonna see sundry accounts.
I'm asking because my friends used to complain
about
sundries.
Don't worry, you'll have sufficient time to look at sundry accounts in unit 4. In unit 4, we'll have a look at that. Okay. All right. So, guys, the transaction that happened on the 2nd, how do we treat it? How do we treat it? We checked a check for 2000 for the petty cash. So let me actually do this. The first thing that you want to ask yourself when you read a transaction is this. You want to ask yourself, which accounts are affected by this transaction? Okay, so assets are affected. Which specific accounts? Petty cash and bank. Okay, cool. Right. All right. So what's happening with the bank account? No. Just think about the transaction. Don't think about the stuff before. Just think about that transaction. Minus what? 2000. Minus 2000. Okay. All right. So we're not worried about calculating the total just yet. We'll calculate the total when we have done all the transactions. Okay.
It would be like theoretically 38,000.
Yes, it would. Yes, it would. Okay. Right. So our bank is decreasing. That's why we said negative 2,000. All right. You don't understand? Okay. Right. So whenever, I'm going to start again. Whenever we read a transaction, the first thing we have to ask ourselves is which accounts are affected. Okay. So since we cashed the check, it's another way of saying we withdrew 2,000 from the bank. And this 2,000 that we withdrew from the bank was for petty cash. So we put the money in the petty cash. Okay? So if we went and withdrew 2,000 from the bank, it means that our bank account decreased, right? Now we know that bank is an asset, right? So now the question is, if bank, which is an asset, is decreasing, what's also happening to our assets at the same time? Are they increasing or decreasing? They're decreasing, okay? So that's why we have a negative 2,000. Another thing that should help you guys as we grasp this concept is deal with one account at a time, okay? Deal with one account at a time. So we've just dealt with the bank, all right? And when you ask yourself, which account does this affect? Don't think about the category, think about the specific account. Does that make sense? And then you work your way up to say, okay, which category does this account belong to? So we've dealt with the bank side of things. Now this 2,000 was for petty cash. So we put this in the petty cash. So we then ask ourselves, what is petty cash?
Isn't it just like change that they keep around?
Yes, change to pay small expenses. But I mean, what category does it fall under? 100%. It falls under current assets. Okay? So then the next question we ask ourselves, is petty cash increasing or decreasing? It's what? It's increasing. How is that then going to affect our assets?
Minus. Would it not minus because you're taking out of the assets to put it in some category? I don't know.
So remember what I said? This is why I said deal with one at a time. So you're thinking of what we did with the bank. So we all agreed that petty cash is increasing. And we agreed that petty cash is an asset. So therefore, how is it affecting the assets? Last 2000, it's increasing the assets. All right?
So be minusing from the bank and adding to the asset.
So basically what's happening, in effect, this becomes zero. I think that's where your mind is headed, which is also right. Okay. So can you see? Now, once again, some of you may be, but how is one transaction affecting one category and one category only? Let's go back to our accounting question, accounting equation C. Did we actually do the right thing? So here we have 2,000, negative 2,000, and we have a positive 2,000, which in effect is what? Is zero. So we're saying 0 is equals to what? What's on the other side? Nothing. 0. So can you see your accounting equation balances? Okay, so are we good? What do you want to?
I just wanted to clarify something. We saw about cash, right?
Mm-hmm.
But what if that also becomes part of the
Nope. I think what's happening is you guys are associating owner's equity to money. Does it make sense? Because also when she spoke about us paying off a liability, she also was saying, shouldn't owner's equity be affected? Okay? Owner's equity is not money. It's the worth of the business. Does it make sense? Owner's equity, okay, let me not say that now because it becomes confusing. But like I said, guys, keep asking the questions. Obviously, explain to the best of my ability. But again, as we do more and more questions, it will all begin to make sense. Okay. Right. So we've done that. Now we can move on to the next transaction. Okay. Next transaction, it says we purchased merchandise, in other words, stock or trading inventory, same thing. All right. Then it says by check. Now, whenever you read a question and it says by cash, by check, or by EFT, it's the same thing. Okay? We treat it the same way. Okay? I see your hand. Yeah.
So I was going to say, so since they've spent this 11,000, okay, so that would it be a minus 11,000 from the bank and add 11,000 on the asset?
So once again, let's.
No, what did I find? So for bank,
yes.
it would be minus 11,000.
So where I want us to start off, and I want us to start off here for the benefit. Maybe you might even be right. I don't know, but I want us to start off with looking at the accounts that are affected, so that we can obviously then build that consistency of the correct approach, which will then obviously land you in the right answer. So the first thing we need to ask ourselves, which accounts are affected? Bank, yes. No, just the specific accounts first. Bank and
trading.
And trading inventory. Okay, so let's now deal with bank. Okay, what's happening to our bank?
It's going down.
It's going down because we're losing money, we're spending. Okay? And we know bank is an asset, right? So positive or negative? Negative. Okay. 11,000, right? Okay, cool.
Plus 11,000 in trading stock.
Yes, trading inventory is an asset and it's actually increasing.
So it would be another 11,000 in assets.
Yes.
So once again, a balance.
Exactly. Okay. Everybody happy? All right, awesome stuff. Then we move on to the next one. And there we purchased office equipment, but on credit for 12,000. Ooh, man. What's happening over here? Which accounts are affected? We purchased equipment. Okay. So usually there's one account which you will automatically be able to pick up. That's been affected within the transaction. Just from reading, we already know equipment is affected. Okay. Now we purchased this on credit. So what's the other?
Liability.
Which account specific?
Credit control.
Yes, credit is control. So now we have our accounts. We want to deal with one at a time. Equipment. Is it increasing or decreasing?
Increasing.
So what's the effect on assets?
When you're getting the equipment, so your value is going up.
100%. It's increasing. So it's a positive. 12,000. Why? Did you say why? Oh, okay.
And then the liabilities also increase.
And then we go to our liabilities, and those are also increasing. All right. Again, the logic is, before this transaction, we did not owe, we only owed 30,000. But now, as a result of buying something on credit, we now owe more. So our liabilities are increasing by 12,000. Okay. And again, we can use the accounting equation to verify. 12,000 is equals to 12,000. Okay, done. Then we go to the 31st. All right, the last transaction for this question. Redeemed, paid off. Redeemed, as we've learned in the other exercise, I see your hand, I'll be with you now, is the same as paid off. If they say redeemable, it means payable. Okay? Within the period they obviously specify. What did you want to say?
So I was going to say, as we've redeemed it off the bank loan, if we look at liabilities as it stands, it's 42,000, but we need to pay. We paid 3,000, so it would be minus liabilities, and that's why we have the 39,000.
So that, let me do this.
So liability would be
minus. Let me do this.
We paid that off.
These totals, when you're in your testing exam, they're not there.
So in that case,
so,
I would look at the 30,000 and the 12,000, and I would minus 3,000 of those together. So 42,000 minus 3,000.
Why?
39. Because we paid off the bank loan, so we have less liability.
But would you be calculating the total before you've actually recorded the?
No, you said we have to deal with one category at a time.
Yes, we do. But what I'm trying to say is, would you be calculating the final total over here before actually having recorded it?
No.
Exactly. So we want to first just deal with this, then we can begin totally.
I was saying, was that how it reached the final answer?
Yes, that is how we, but the whole thing is, I just want to, guys, I know some of you maybe are already ahead of us, and that's fine, all right? And I apologize if I bore you to death at the pace at which I'm moving. But the reason why I'm doing so is because I know some of us have never had accounting. And some of us might have had it, but yay, it was rough, okay? So I'm just trying to get you to a point, because if we tackle these things step by step, if I just tell you a transaction and I say which accounts are affected, stop there, and you tell me which accounts are affected, you need to see, okay, this thing is possible. Then we break down, okay, where do we put the amounts? Is it plus or negative? You begin to see, okay, I can do that much. And then, before you know it, guess what? We've inserted all our information, and guess what? You can now total. So that's why I'm just taking you step by step by step by step. There's going to come a time where we're going to be moving a whole lot faster, okay? But for now, I really want to make sure you grasp what is it that we're doing, how are we doing it, and what's the best way to approach it, okay? Right. That's it. Let's record this transaction and get it moving. So obviously, bank is affected here because we're losing money, okay? Right? So here, say negative 3,000, okay? At the same time, we know that the bank loan is going down, so our liabilities is decreasing, so negative 3,000 again, okay? And then that's how we got our, okay, plus or negative? Plus 39,000. Okay, and then here it's obviously 10,000. Okay, and then here, what do we have? 49,000. Okay, and that's obviously here, plus as well. And once again, can you see something very interesting? Our assets
equal the liabilities.
Right. So again, can you see our accounting equation has to hold true? All right. If it doesn't, then we know somewhere I may have made a mistake. Okay. Right. So that's 2.5. Are there any questions so far? Are we good? Okay. So we can move on to question 2.7. Okay. Did you manage to check if this extra work pack is under more resources? Not there. Okay, so please just remind me as soon as we end the session that I upload it. And then, yeah, the guys who are seeing me for the very first time, we need to remind me again at the end of the session. I'm going to guide you as to what you need to do in order to get up to speed. But we haven't covered much. It's just theory things that we've touched on. Okay. Right. And you haven't missed anything from Unit 2, because literally we did a recap and we did the exercises that I wanted us to do in Unit 2. So it's really just Unit 1 that you need to get cozy with. All right, so now we want to go to 2.7. Okay. Right, and here we're gonna move a little bit faster, just a little bit. Okay. What page is that? All right, 60 in your book. Okay, mine it's on 57. Question 2.7. Okay, so here I'm not even going to read the question because I know what the question entails. We're doing the same thing we were doing earlier, and then the second part of it, they want us to calculate profit. Okay, right. So let's get into it. Okay, so at the very top of that question, they say Putin wholesalers trades in office furniture. So we already know the nature of this business is office furniture, 100%. All right. On 1 September 2007, the accounting equation of the business was as follows. Okay. So here they're giving us what? Exactly, the opening balances. All right. So this is 1 September 07, I believe it is. Yes. Okay, and the assets was how much? Somebody tell me.
415.
415. Okay, and liabilities. Oh, wait.
83,415.
All right, plus
Liabilities is 150,000.
83. Sorry, I'm not that fast.
83,415.
83,415.
83,415. Not 8.
Oh. Okay. Hey, and then liabilities is what? 150,000. All right, cool. So we've got that in there. So let's now jump into the transactions. And then they said ignore that. Okay. So on the first, it says the owner, Mrs. Helen Putin, made a capital contribution of 75,000 to her business. Capital contribution of 75,000, and it goes on to say this was done by means of an electronic transfer from her personal account into the business's account. Yes, owner's equity, but which specific account? Which specific account? We want to. In other words, yes, but in other words, bank. Business account, in other words, bank. So you wanted to say something, and yes, capital is also affected. You want to say that? Sorry, I can't hear you. Zoom in. Oh, okay. Can you see better now? Okay, cool. Right. So bank and capital is affected. Okay. So obviously in assets we're going to say plus 75,000. Okay. And capital we know affects owner's equity. It increases owner's equity. So here we're going to say plus 75,000. Okay. Yes. Assets affected is because bank is affected. Bank is a current asset. Okay. All right. Yes. Yes. Good question. It's her own money. But in accounting, and I don't think I said this the last time we met, or any time we actually. In accounting, what we are doing, we're not worried about the owner and her financials. We're worried about the business's financials. So we're doing the books of the business. Does that make sense? So that's why it's a plus on the assets there, because we're saying the business now has 75,000 sitting in the bank that it didn't have before. Makes sense now? All right, cool. Right, Good question. Then on the 5th, it says we purchase trading inventory on credit. So which accounts? Specific accounts. Whenever I say which accounts, I want specific accounts. No, there's category, creditors, and trading inventory. 100%. Don't get a headache now. It's too early.
I was trying to look through these 3 ones.
Okay. Yeah. No. Don't. No. There's ample time. We'll get to things worth stressing about. Don't worry. All right. So this is the 5th of September, 07. Okay. And we said what did we say? In trading inventory, which we know is an asset. Okay. So that's a plus. Ish, guys. Sorry, I just can't hear you. 34,000. All right, perfect. And then we know liabilities is also affected. We owe more, so it's a plus or minus? Okay. Is it now starting to sink? All right. Counting is easy, ne? Too easy. Y'all are all geniuses. Then we go on to the next transaction, and it says sold merchandise on credit. Sold merchandise on credit. And it says for 9,000. Okay. And then it goes on to say the goods were originally bought for 6,000. Now, guys, remember what I said in the last class. Either you are writing or calculating. If you are just sitting and looking at us, I have a problem. Okay. And I'm not going to force you to do anything, but at the end of the day, trust me, the more you engage with us, whether it's verbally or via calculation or jotting down your notes or putting down amounts, the more you are likely to remember. All right? The more you are likely to remember. So please, I am pleading with you. Make sure, especially when we're doing calculations, doing exercises, that you are writing down or you are at least calculating. Okay? So that you remember these things. Okay. Right. So then, all right, that's on the 6th. So again, all right, you can just put it down there. Thanks. Okay. On the 6th of 09/07. Okay. Which we sold inventory, right? On credit. Yes. Debtors control and
Inventory or trading.
Same thing. Merchandise, trading stock, inventory, same thing. What did you understand? For 9,000. We sold it for 9,000. And then the twist. We'll get to the twist. Okay. Get to the twist. So here's the thing. Whenever we sell, right, inventory, there's 2 double entries that we need to record. But for now, I want us to deal with the first double entry, which was debtors control and trading inventory. All right, or stock, merchandise, same thing. So let's record that. We sold this stuff for how much? All right, so this is a plus 9,000 in assets for the debtors control. Okay. Then we also now need to adjust sales. Yeah, no, we're gonna get there. We're gonna get there. We have sales that's affected because we sold something. Does that make sense? And we know sales is what? What type of account is it? It's income. Income affects owner's equity. Okay, so here we're going to say plus 9,000. Okay, so that's the first double entry. Okay, that's the first double entry. Now we can begin to deal with trading inventory. Okay, and what's the other account? Because there's trading inventory and that's the category. The other account that's affected. So Whenever we make a sale, there's a cost that we need to account for. Cost of sales. All right, so we need to account for trading inventory and cost of sales. And at what amount are we going to account for these? This is where your twist comes in. What did the question say? It said the goods were originally bought for. All right. So in other words, the value of this trading inventory was. Oh my goodness, this guy's mind is so far ahead of us. Just stay with us. Just stay with us, okay? I can't even think that fast. I can't. All right. So as you were saying, yes, we bought it for 6,000. Okay. So under assets, the trading inventory is going to decrease. So it's going to reduce our assets, okay, by 6,000. Okay. Then cost of sales, we know it's a what? What type of account is it? What category does it fall under? Cost of sales. Expense, okay? Expenses do what? They decrease what? Owner's equity, okay? So owner's equity is also going to be affected. So negative 6,000, okay? Sorted, okay? So can you see? The first double entry was debtors control, which affects assets, and sales, which affects owner's equity. That was the first double entry. So what I want you guys to do, whenever we sell something, whether it's for cash or credit, I want you to first say, let's deal with the sale. In other words, the income that was generated, all right? Then let's deal with the fact that we reduced our inventory, okay? And then we obviously, in that instance, we're dealing with cost of sales and trading inventory. Does that make sense? Break it up like that, okay? Otherwise, if for any reason you actually went the other way around and first recorded the minus 6,000, you would still be right. Okay, but I think it's easier to say I made a sale. Let me deal with that first and then move on to the fact that your inventory has decreased. Okay, cool. Then we move on to the next transaction. Okay, where it says paid casual wages from petty cash, 600. Okay, so which accounts are affected? Specific accounts. Petty cash and salaries and wages, yes, which is an expense, okay? That happened on the 7th. Okay, so I'm just going to do this in the interest of time. All right, we all know this is pertaining to September, so that's fine. So 600 from petty cash. So petty cash is decreasing our assets by 600, okay? And then we know owner's equity is affected because salaries and wages is an expense, so expenses reduce our profitability, which obviously affects owner's equity. Okay, negative 600. Okay, the number of students who don't know where they're supposed to be is shocking. This far into the semester, I've had that in almost every lecture today, and I've been lecturing since 8. So, yeah, rather shocking. Yeah. I thought I also heard that. I wasn't sure. It's okay. It's okay. Join the cool club. Right. Let's move on. On the 8th, it said paid for repairs and maintenance by check. Which accounts are affected? By check. Bank is affected and by check. So bank is affected, can't be creditors. And repairs and maintenance. Remember, there's one that's always just there. Okay? Right. So bank, we know, is an asset. It's decreasing our assets because it's going down, right? So what's the amount there? 2,538. Okay. Then we know that Repairs and maintenance is an expense, so it's also going to decrease our owner's equity by 2,538. Okay, this happened on the 8th, right? Then the next date that we have is the 13th. Okay, and what happened on the 13th? Let's see. Issued a check for 1,845 to pay water and electricity. So we issued a check, right? It's the same, all right? It's the same. So that was 1,000. Nope. Where am I? Yeah, 1,845. Okay. So bank is decreasing our assets, 1,845. This is an expense, so it's decreasing our owner's equity, 1,845. Okay. Right. Then we go on to the 16th. We purchased a computer for the office on credit. Okay. For 21,930. Which accounts are affected? What did we just buy? We bought a computer. So computer equipment is affected, and we bought on credit. So which other account is affected? Creditors control. Okay? Right. That happened when? 16th. Okay. Right. So obviously, because we now have a computer, which is an asset, assets is going to increase by 21,930. Okay. All right. And since we bought it on credit, creditors control, we know that liabilities is going to be affected, and we know it's a plus because now we owe more than we did before this transaction. So 21,930. Okay. Okay. Then next one on the 17th. What happened on the 17th? We purchased office refreshments by check. By check, the moment you see by check, by EFT, by cash, or for cash, all right, we know it's bank. Okay? So what's the amount there? 4,500. So this is going to be a negative 4,500. Okay? What was that for? Office refreshments is an expense, okay? So negative 4,500. Okay? Right. 19th, purchase packaging material on credit. Which accounts are affected? Bank? Are we sure? Are you sure? Packaging materials definitely, because that's what we're buying. Yes, so creditors control. All right, so that was on the 19th. So bank is not affected. Okay, that was an expense. So obviously, owner's equity packaging material is an expense. So owner's equity is going to be affected. 5. Okay, and then we know that we bought this thing on credit. So creditors control, therefore, but here it's a plus. Can you see the mistake I almost made? Aha. 365. Okay. And if you add up, what do you get on the other side of your accounting equation? 0. Okay, so 0, 0. Happiness, right? Okay. All right. Next transaction happened on the 24th. Okay. 24th, purchased fuel. Fuel we know is an expense for the delivery vehicle from petty cash. Okay. So petty cash we know is an asset, right? So if we're purchasing from petty cash, what's happening to the petty cash? It's decreasing. So our assets, what's happening? Decreasing. Okay. What was it? 450. Okay, cool. Right. And then we know fuel is an expense, so that's also minus 450. Okay. Right. And we can go on to the next one. Sold trading inventory for 4,500 cash. the goods were originally bought for 3,000. Seeing right? Yep, 3,000. Okay, so that happened when? That happened on the 25th. So remember what we said? We want to deal with the first double entry. Which accounts are affected with the sale? Well, yes, trading inventory, but with the sale, the first half. We sold for cash, right? So whenever we hear the word cash or check or EFT, we know bank is involved, okay? So bank is affected. Is it increasing or decreasing? Aha, it's increasing because this is money coming in. We made a sale, all right? And 4,500, because that's how much we sold for. Make sense? Ugh, why am I doing that? Okay, so bank was affected. What's the other account that was affected? What did we actually do here? We sold 100%. So we're still on sale. So owner's equity is going to be affected, all right, because it's an income. That's also going to be a plus because owner's equity is increasing. When we have incomes, owner's equity increases. When you have expenses, owner's equity decreases. Okay, so plus 4,500. Okay, now we've recorded the first half, all right? Now we can go on to what you were saying with the trading inventory, okay? And somebody mentioned cost of sales, so now we can deal with that. That's now focusing on the fact that inventory has left us, okay? Or stock has left us. So here we know that we bought that inventory for how much? 3,000. So we record it based on its actual value or cost to us. And then cost of sales, which is an expense we know is decreasing our owner's equity. Okay, so there we go. Right, we've recorded that transaction. Any questions? Is everybody good? Cool. Then on the 26th, it says, what did Mrs. Putin do? It says she took a couch from the trading inventory for her personal use. Okay, the moment we see personal use, what does that tell us? It's drawings, okay? Drawings. And it says set was originally bought for 12,000, sorry. Was originally bought for 12,000. Now, what does this tell us about drawings? Why does it tell us about drawings?
You mean you have to increase drawings? Because it would be like sort of like a liability to take account.
Well, in the T account, yes, you're going to increase drawings. Yeah. Is it an expense? Anybody?
Subtracting from your assets and your owner's equity.
Yes, it's going to affect owner's equity. I agree with you there. But is drawings an expense? What category does it belong to? Aha! Drawings and capital. Remember, drawings and capital is a proprietary. They're proprietary accounts. Okay? Those are the only two proprietary accounts. Okay? So just remember that. When it comes to the transactions, the things we do with the owner, those things belong to proprietary accounts. Okay? Okay, cool. So we mentioned that that's obviously going to affect owner's equity. Is it going to increase owner's equity or decrease owner's equity? It's going to decrease owner's equity. So this is going to be a negative 12,000. Okay? Right. Then, what else is affected? What did she take out of the business? Do you want to ask something? Okay. What else? She took what? She took assets. She took trading inventory. Okay? Right. So, trading inventory we know is an asset. And what's happening? Is it increasing or decreasing? Decreasing. Yeah? All right. So, negative 12,000. Okay. Right. Cool. We dealt with that. Then the last transaction. Can you believe it? We done, guys, or almost done. Received a check for 3,000 from a debtor in part payment for or of her account. Hey, which accounts are affected? Which specific accounts are affected? Bank and debtors control, 100%, guys. See, I told you, you're geniuses. Beginning of the session, you're like, this. But now look at you, right? Bank and debtors control. Okay. So then the next question is, this happened on the 30th. How do we record this, guys? Which category is affected? Assets, okay? Because bank is an asset and debtors control is an asset. So which one are we going to start with? No, okay, so we're going to start with bank. Now, what happened to bank? It increased. So how does that affect our category? How does that affect assets? It increases, okay? Cool. So plus, is it 3,000? Okay. Right, cool. Then we know that, what is this? We know that debtors control is also, huh?
Like, you know, with liabilities, you know, when you pay someone pays it, pay goes down.
So you guys tell me. Are we minusing or adding? What's happening here? Okay, we're minusing. You guys are 100% right. Okay, you're right. Okay. This person owed us, let's just say, 10,000. They've come and they've made a part payment of 3,000. What they owed us is now 7,000. It has reduced. Okay, so debtors is going down. So that means our assets. What's happening? We know that debtors is an asset. So what's happening to our assets? It goes down. Okay, because we have less. We have less that is owed to us. Does that make sense? Okay. All right. So here, 3,000. Okay. Done. Yes. All three. It is possible. Yes. It is possible. It is possible. Okay. Just maybe think of an example now, but I have seen that. In fact, the first one we did, the first accounting equation that we did you see? When the capital she put in the business, 40,000 cash sitting in the bank, then there was 10,000 of her own money in terms of that 40,000, and there was 30,000 that she borrowed from the bank. You're thinking of the total again. All right? So that's how all categories, but there's different instances where obviously the total, all of them can be affected. All right, cool. So guys, that's your accounting equation. Then obviously you just need to total there. I can see my students are tired. So what I'm going to do here is I'm just going to go to the answers and I'll explain, but we have covered the cracks of what we want to do today. Or are you guys still fresh? Can we do a whole other exercise? But you guys love accounting. You're so good at it. All right. So these are the totals that we get when we add up everything, okay? All right. And once again, if you want to check, did we do the right thing? You add those two together, you should get this amount, okay? Right. Now here, remember this was the first thing we were supposed to do. We were supposed to calculate the owner's equity. So that's her owner's equity, okay? Now, the second bit was to calculate the profit or loss, okay? Now, how do we calculate profit or loss?
Assets minus liabilities.
Are you sure?
No, I'm not. That's why I'm here, sir.
Yes? Oh, yes. Bunch of geniuses. Minus expenses is going to give you your profit or your loss. Your income minus your expenses. Simple, simple, simple. Okay? Right. So, how do we do this now? Okay, I'm going to zoom out a bit just to show this bit. All right. Now, which category was affected by income and expenses? Owner's equity. So if we want to get through this as fast as possible, what we would then do is we'd look at this column and then say which transactions pertained to either income or expenses, because that's what we want in order to calculate our profit. Okay, so when you scroll down here, okay, I'm actually just going to do it this way. Yeah, so when you scroll down here, you see that on the 6th, what happened? We made sales, which is an income for 9,000. Okay, we plug that in. Then, but we also had an expense on the 6th, which was cost of sales. So we need to deduct that. Then we go to the 7th. What happened on the 7th? We paid wages. Okay? Wages is an expense. That's why it's got a negative 600. Okay? Right. Then we go to the 8th. What happened on the 8th? We paid for repairs and maintenance. So this should be a negative. Okay? All right. Then on the 13th, what happened? We issued a check, all right, for water and electricity, another expense, okay, 4,500. Oh, wait, no, it was the 1,840. Okay, so and then on the 16th, what happened? We paid for, but that was on credit. Okay, so can you see there was no income or expense there? Okay, so we go to the 17th. What happened on the 17th? We purchased office refreshments by check. Okay. So office refreshments is an expense. All right, 4,500. Then we move on to the next. On the 19th, what happened? We purchased packaging material on credit for 1,365. Okay. Even though it was on credit, it's still an expense that at some point in time we are going to need to pay for from our own pocket. Does that make sense? Okay. So even though something was done on credit, we still recognize it, all right, if it's an expense, okay? Still recognize it if it's a sale and income, okay? Right. Then on the 24th, purchased fuel, okay? We know fuel is another expense, 450. That's where that 450 is coming from, okay? Then finally, well, not finally, second last, on the 25th, what happened? 25th, we sold goods for 4,500 cash, all right, sales and income, all right. So then we recorded that as a plus, and then finally we received, no, that's not it. Oh, that very same transaction on the 25th, we accounted for cost of sales, which is an expense, and that's why we have the negative 3,000 there at the end. Then when you calculate all of that, when you add those amounts together, you find that we actually made a loss of 6,798. Okay, so what we're just trying to illustrate with that exercise is that expenses, you're calculating your profit is income minus expenses. Okay, right. Okay, so we've done that now. Then I said there were two things that I needed to tell you guys before I let you go. Everybody sign the register? Okay, fine, perfect. All right, so let me just stop this recording.